Okay, so this goes two places. This gets posted on Friday. The video version gets posted on Friday for Casual Friday, and then also the audio version of this gets posted on the Financial Insights podcast. So I have been promising people on the Financial Insight podcast for weeks now that you were going to be back. And then scheduling conflicts, vacations. I think has it been a month?
Probably.
Okay. So, we were talking
but I'm back.
But you're back. Yeah. We're talking about, well, where are we going to be? I'm not sure. Here's for the record, as we're recording this, in the last month. So this is the last week of May to the last week of June here. NASDAQ up 4.8%. S&P 500 up 4.3%. The Dow is up 2.67%. We've been ripping. Now we went up and came down a little bit. There's a little bit of we stepped off we took our foot off the gas, you could say, for a little while. But overall, things have done pretty well in the last 30 days.
Yeah, we had a good June, assuming we close out the week where, at least at where we are, I think clients would be pretty happy with the results from June. We had a good month, obviously, in January to start the year, and things went back down, and we're kind of back to where we once were at the end of January. So it feels good right now. It's like there's not a lot of negative news, and I think maybe that's what's carrying the markets probably more than anything. Is that we had a banking crisis in March, you had a debt ceiling issue in May, and now that we don't seem to be worrying too much about some of this ancillary news, the markets are just moving up.
Yeah, well, I mean, there's always a crisis, real or perceived. I don't know what the next one's going to be, but what it is, right? But we don't have one at the moment. I suppose the stuff with Russia and the coup or mutiny or whatever that everybody's calling it could have weighed on things, although the market seems to have ignored that altogether. The first 2 steps forward, 1 step back is still progress, and that's a lot of what we had in the first half of the year. I've talked with several clients just today saying, I get them on the phone and they say, okay, tell me, how bad is it?
Yeah.
It's not bad at all. S&P 500 is up almost 15% on the year. And they're shocked. What? And the way I describe it is, if you're watching the news, it's only bad news, right? It is not 100,000 planes landed safely today.
Right.
It's one plane crashed.
Yeah. Yeah.
And the proof's in the numbers. You can see here, I'm going to add the NASDAQ. This is the best first half of the year for the NASDAQ ever. At least this is what's on track. This is from Bloomberg. I'll post a link to this in the show notes, both for the podcast and for the Casual Friday webcast. And then you can see even we're right on track. This is from Detrick over at Carson Group. He used to be with LPL. I'll link to this also so you can find it in the show notes. Late June, stocks tend to bounce. And what do you know? We're doing precisely that here in these last couple of days. I mean, who knows how the last day or two is exactly going to finish. But, boy, make no mistake, the news has been good. I don't even know about good. The news hasn't been bad. Let's put it that way.
Right.
Yeah.
And I think if we kind of have a normal, maybe we have a second half, hopefully without a lot of major crises, and maybe if the economy can hold up, right? Yep. I think that's going to be the big question for the second half of the year.
Yep.
We probably move away from interest rate talks, as the year goes as well, which has been the main focus for the past almost year, 15 months.
Yep.
Maybe no news is good news, and the markets can kind of, at worst, at least hold where they are, because again, returns are pretty good. I don't think that it's reasonable to think that if you have a really hot market like you showed in the NASDAQ for the first half, that you're going to have a repeat of that for the second half.
You can't say this.
That's not a reasonable thinking.
No.
It's also, maybe it's like, if you were to do if for any of us were to do a 100-yard sprint most of us would probably come out of the gates really hot, but by the time you get to the halfway point, you're probably starting to fade. It's so it definitely could be like that, because when you start hot in the beginning of the year, the reasonable expectation should not be that you're going to just double that same return for the second half of the year, and you're going to end up with twice as much.
Well, what are the unknowns here? We don't know if the Fed is going to raise rates another 0.25% or 0.5%. I would argue it's kind of inconsequential. There's some dispute over what the Fed's actually looking at. Are they looking at inflation, or are they trying to actually defeat this tight labor market, which would suggest even if inflation is going down, they're going to keep raising rates until we find ourselves in a recession. If we have a recession, how bad is that going to hurt earnings? Is it already priced in? I mean, these are all things that need to be kind of sorted out here. So you're absolutely right. Just because there's been this relief rally for 6 months, coming off of a terrible year last year, it doesn't mean we're out of the woods by any stretch.
Yeah, I would say, interest rate hikes are probably, like I said, feels like they're mostly behind us. Even if there's a interest rate hike 1 or 2 times, I don't know that that's going to really rattle the markets too much. Obviously, I think a recession would, just because you usually will not have a recession and a market that goes up at the same time. Like that's just not.
Well, I mean, historically, markets bottom right at the beginning of a recession.
Yeah.
And so that would suggest that like last October wasn't the bottom, which I think is scary for some, especially the run we've been on.
Right.
But it's hard to say for sure. It's hard to say.
Yeah.
So on a different note, one of the defensive positions that people will take, although some may say that mega cap tech has become defensive, not growth. Healthcare is considered defensive, right? And so as a pickleballer, you can appreciate that pickleball is affecting our healthcare system with pickleball injuries. I will tell you a couple anecdotes. One, I'm getting my Achilles finally sorted out here, so I can keep playing tennis. And the guy who's working on my Achilles said that he saw tons and tons of injuries that he was working on last year because of pickleball, because everybody got off the couch and then started getting exercise again and hurt themselves.
Yeah, I would actually add to that too. I think, one of the big things about pickleball is that why it's become so popular is a lot of people are capable of playing it. Like just your non-athletic people,
you walk out and do
it. Anyone really almost can get into this game. But when you have people that have not been active, go become active, as even though this is not, again, tennis where it requires a ton of athleticism. Any kind, getting yourself to that point where you're moving a lot when you haven't, I think creates a room for injury. I will say for myself, what happened to me. Like, I think this was my 4th or 5th time playing pickleball. It was Super Bowl Sunday. I was running for a ball. I bent over, lost my balance, tripped, fell into the side gate, gashed open my head. So it was bleeding. All the courts at the club stopped because they heard me run my head into the gate. I'm bleeding. Of course, the people that were there, the people that were playing with me, wanted me to continue. So, sure enough, I stopped the bleeding to an extent.
This is from Axios, and according to them, here it is right down here. I don't know if I can annotate this. Can I annotate this? No, I can't. 3.5% of all pickleball injuries are face. And I will tell you, we at Fig Garden, we do Fig to Brig. In the middle of summer, actually, the genesis of this was tennis. And the tennis, like the Tuesday night tennis group going and doing this thing. Anyway, they did pickleball this time instead of playing tennis, which is really blasphemous. But anyway, there was a face and finger injury coming from somebody actually did something and hit themselves in the face with their pickleball paddle, and it required stitches on their eyebrow. So
I'm not going to deny that I've hit myself with my pickleball paddle before, but not to the point where I needed medical intervention.
You did not get stitches on your face?
No, but it doesn't feel good.
Yeah, I can't imagine. Not. Well, so we did a little bit of a market update here, right? Which is what we often do, which is we're going to have a mid-year outlook, of course. And so if you're subscribed to our YouTube channel, you will be able to see it in your feed when we do that. We're going to make it available to clients first. So if you're listening to this or watching this and you haven't seen it yet, you can talk to your advisor about getting the replay of our mid-year outlook, and then we'll post the audio probably, or a version of the audio, maybe the executive summary on our podcast. But that's the mid-year stuff. We still want to go through our charts though. Ryan, do you want to start with your chart?
Yeah,
And we can kind of take a look. Tell me a little bit about what we're out. And both our charts today are from the Visual Capitalist, which is a site that has very cool charts, many of them money related. And so that's where today's two charts are from. And the first one, Ryan, you want to run through this a little bit?
Yeah. So as many people know, we were dealing with the debt ceiling issue with what the government was going to do in May. And of course, they were able to come to a resolution to where it really didn't have any impact to anyone. Maybe a little bit of stress coming towards the end of May, but the markets actually were pretty calm. This is just a kind of an interesting thing because I do think I get a lot of meetings still, even when this is not top of mind in the news. People have concerns about how far a debt has gone. So it's somewhat still timely with us reaching the agreement. But what this is it kind of shows historically since 1970, what the debt ceiling has been, what our debt has, how much it's gone up over the course of time. I think that's maybe why I wanted to focus on a little bit more. Now, the debt ceiling really is just kind of, if you think about it, it's the government's budget, right? Like some people have a personal budget. Yep. I'm going to spend this much and I can't spend more than this much on my expenses during the month. This is what's kind of the debt ceiling is for the government. It's a set amount that they're supposed to stay within. You can see that, of course, like anything, the debt ceiling has gone up over the course of time. And if you really kind of focus in, I'd say probably more in the last 20 years, it's really started to balloon. And I think that's really where the concern comes from with a lot of people. Clients come and mention this every now and then during my annual meetings that, this is a concern. Right. One other thing I guess you can take away from this is if you look at that light green line, it's called the U.S. nominal GDP. So it's kind of a way to measure saying like, this is what the U.S. produces. And you can see that for a good period of time from the 70s up until, even 2010, right, we were pretty good about keeping our spending in check with how much the U.S. was basically making in GDP. But as time has gone over the last 10, 15 years, we have started to well exceed our own GDP. And I would say this, Brian, you probably have heard and through research and articles and podcasts, there's not really an answer to this in terms of, how much can you spend before the day of reckoning comes and it becomes too much of a problem. I would say personally, like in personal finance, if you start to outspend, and create more debt for yourself that you can't actually pay back, that day of reckoning is probably going to come sooner than later. Like you can't realistically say, I think it still can happen 20 years from now. It's probably going to happen a lot sooner if you can't make your payments.
I would say the debt ceiling thing is silly because what happens is Congress has already decided to spend beyond the debt ceiling through passing a budget. And so they have to, they make the financial decisions first and then come on after and then have to allow themselves to follow through on the financial decisions they made. I'd say really what is worrisome here if we're looking at the debt ceiling, because these aren't adjusted for inflation or anything, is the debt to GDP ratio, where there's a book called This Time It's Different, and the focus of it is debt to GDP ratio. And I don't really remember what the debt to GDP ratio thresholds are. It's either, I want to say it was 90%, but it might be 77. Either way, once a country gets too far beyond its debt to GDP ratios, you start running into problems where a country is at risk of defaults. It hinders GDP growth. And we are, in the last 3 years, we've crested above that 100% debt to GDP ratio, where we owe more than our debt is more than our GDP.
Right.
And that is troublesome.
Now, there are other countries that have high debt to GDP ratios. Japan is the one that's often pointed to. And as many of you know, Japan's a large economy. They still function very well, right? Yep. So we haven't had many examples in recent history, or maybe ever, of a large economy
Yep.
having a severe problem because their debt to GDP ratio has gone against them, or it's gone too high. So again, all of this is very theoretical right now. Whenever this discussion comes up, there's not really a right answer to this that
Yeah.
says if we're at 129% debt to GDP ratio, as you can see at the bottom right chart,
Yep.
it doesn't mean that if we get to 150% that we're going to implode, right? That's not the case. We don't know when this starts to become more of a problem than what it is.
Yeah. I know the book, the This Time It's Different book cites, I think it was the 1930s for us, the third world debt crisis in the 1980s, Asian and Latin American meltdowns in the 90s, all kind of correlate. It's been a while since I read this book, but all correlate with debt to GDP ratios that are getting out of control.
Well, we also used to use this analogy back in, I always say, like the financial crisis. We used to say being the cleanest shirt in the laundry, or it's one of those.
The cleanest dirty shirt,
the cleanest
shirt in the dirty hamper, or whatever.
Yeah, we have to realize that while we have problems, so does everyone else, and so this is relative.
It is.
It is. You can't just say, well, we have our numbers don't look good. Well, there's a lot of countries' numbers that don't look good.
Well, here's the thing: getting a grip on this is going to be painful, and you can see this stretch, basically running from about 2010 to 2020. Like we went almost exponential with our debt, but the interest rates were much lower.
Yes.
So it's going to be interesting to see. In fact, this may be a good place to transition to my chart. The interest rates were much lower, and so it's maybe it was, I guess, I don't want to say easier to run it up, but
when interest rate payments are high, it certainly compounds on itself already.
Yeah,
that's something that's already going wrong. It's like adding another expense item on top of your expenses.
Right. So the other chart we have up here are the interest rate hikes, and so we're kind of, I guess, pivoting from two of the bigger stories in the first half of the year, right? One is the debt ceiling. We're going to leave the Silicon Valley Bank stuff alone, but interest rate hikes, which is frankly one of the causes, probably the Silicon Valley Bank, is addresses the interest rate hikes. And I love this. I wish I'd found this sooner as I was having conversations with clients about this, because I was showing everybody a chart where we were walking through interest rates and how I'm going to move this around a little bit. Interest rates and how we've been higher than we are now, but we haven't moved faster in interest rate increases in our lifetime. And that shows this pretty clearly. I mean, we're talking about 5 percentage points over about a year's period of time. And so how does this look compared to the last 5 years? I would say a comparable rate of increase was 04, 06, which you can kind of see right here. It was essentially 4%. And that's what broke the housing market because of all of the kind of debt that was piled on. But they stopped raising. It was 04 to 06. It took until 08 for it to be felt. So you kind of wonder, on this 5% rate increase over the last 12 months, how long is it going to take to be felt? I know this is starting to sound pessimistic, and we're really not pessimists here, because some of the technicals show that we're on a pretty good rally. But you have to wonder, what are we going to break here? What's going to happen? How is it going to hurt? Is it going to be in commercial real estate? Is it going to be some other way? But I love how this illustrates how we are higher and faster than we've been in decades.
Well, I think the one thing that we've felt so far has been the equity markets. The interest rates hike started last year in 2022. And we definitely felt the pain from the bond and the stock market standpoint, right? Yeah. So in the investment world, we had a large effect of what the interest rates were doing, and we felt it last year. Now, outside of that, it's kind of hard to say at this point in time what the effect is. We do kind of feel that the maybe not the commercial real estate market yet, but definitely the residential real estate market has been affected because no one that has a 3% mortgage wants to go trade that in for a 6 or 7% mortgage. So I think the real estate market has definitely slowed from that standpoint.
Well, and we're not leveraged to the hilt in residential real estate. The commercial real estate is a whole different ball of wax. I think there are a few things here. If we're just going to slice the blowing a little thinner, the 15 to 18 rate increases was about the Fed trying to take back control because they were operating with rates as low as they were after the great financial crisis. They were trying to actually put some ammunition back in their chamber, if you will, to be able to combat whatever was coming. And so these rate increases right here were more about the Fed trying to get back to normalcy as opposed to battling inflation. 99, 2000, this is preemptively raising to try and curb the inflation risk that was coming from the tech bubble. We saw how that turned out. 04, 06, this is, again, trying to cool things off, and we saw how that turned out. 88, 89, price pressures are coming again. That's what led to the brief recession that we had in the early 90s that helped get Clinton elected. So, more of these than not have led to a recession. How deep and how long is kind of, it varies a little bit, but I don't think we can look at this and say, well, these rate increases cause recession, but this one won't. It's coming.
The Fed had actually stated that, right? That, there could be through their actions, raising the interest rates and doing what they need to do to combat inflation could cause a recession. It's something that they said that they could deal with, when that time comes, if it comes. Right. So, I mean, I think that they were well aware that this recession possibly could come. I mean, when you raise interest rates in a small window like this, to the extent that we raise them, it's going to eventually slow things down.
Now, some differences we have. I mean, these rate increases are accompanied by more inflation than we've had since the early 80s.
Yes.
Right. So that's different there. We also have big demographic changes where we have a massive entire generation of people starting to retire, and the baby boomers finding their way into retirement. And so that changes the labor demographics, which is one of the things that they're trying to combat. So we can't just say, oh, rates went up, therefore recession. It could be steep recession, shallow recession. I think it's still likely a recession, but you just can't look and say the correlation isn't that definitive. Right.
Right.
But it's pretty clear that I think this just adds context. It feels like rates have gone up really quickly. Well, it feels like that because they have. Is literally the bottom line here. But I love this chart. I would print this thing out and hand it out in the lobby if I could. So interesting. I think this is the point of I won't say the presentation, but this is the point here where we always say also, the economy and the markets are not the same thing, right? We didn't have a recession last year. Markets cratered in anticipation of a recession. How much of that is already baked in, or how much anticipation of recession is already baked in? And it's kind of an open question still also. So a lot of this rhymes with what's gone on in the past, but it's not exactly the same. So you can't just make a carbon copy. Well, this happened last time, so this is what's going to happen this time. It doesn't quite work out that simply, right? Okay. Well, we went through our charts. We kind of did a recap here. What has your attention here this week? What are you looking at? What are you watching? What are you doing? What are you reading?
So my attention, it's funny. I went on a family trip we were in Canada, and one of my favorite things in Canada that we don't have here, which I don't know why, is poutines. Have you had poutine before? Okay, never. So for those that don't know,
was it cheese curds on French fries? Is that
basically? So it's French fries, gravy, curds, right? Yep. And then you can add whatever you want to, depending on the place. Maybe they have a bunch of different other toppings. I love it, but I love fries. I love gravy. So you might mix the two together. But my thoughts are, it is great. I appreciate it because I've gone to Canada a few times, and I always make sure I have it multiple times while I'm there. But why we don't have it here? Because I would thoroughly enjoy it if there were restaurants that actually had this, that I could enjoy it here. Because it's not often that I make it up to Canada. So, it's not often that I'm able to have poutine.
Yeah. So did you have it multiple times or just
I
one time?
had it 4 times.
4.
Yeah, 4 times,
How
different
long was your
places,
trip?
and it's good to compare. I had one where it was like a
How
lobster
long was your
protein.
trip?
We were there 10 days, so once
So
every other
4
day-ish,
out of the
about
almost half of the days you were there, you were
yeah.
in
Yeah,
between?
I tend to go overkill if there's something I like in an area.
Did you have it twice in one day?
No, I didn't do that.
Okay. Oh,
Yeah.
yeah, I know, right?
Yeah, it's crazy, right?
Gotta have some boundaries there. Well, that's good.
Yeah, what about you?
Well, I saw that you were in Montreal, and I was jealous because you were there during the F1 race, um, which I desperately want to go to. I have no interest in the local in the well, no, I don't want to say I have no interest. The Vegas F1 race is going to be insane. Miami is already insane. There's like 500,000 people that show up in Austin for the US Grand Prix or American Grand Prix, whatever it is. And so I thought Montreal would be a better one to go see because I haven't been to an F1 race in person before. So I was jealous of that. I'm doing something a little bit different. I'm actually getting caught up on reading on a few different things. We're trying to this might be a whole nother post, but we're trying to get the kids squared away on um, their finances, trying to
Okay.
get a better system of um, allowances for
Allowances?
them,
Okay.
teach them how to spend, do the spend, save, give kind of buckets.
Mhm.
So I'm reading Smart Money, Smart Kids by Dave Ramsey. I know Dave Ramsey is loved or hated by a lot of different financial professionals. I think some of what he says is really spot on. Some of it misses, but there aren't a whole lot of resources for kids and money and helping parents teach their kids about money. And we're trying to do a better job of that with our kids. And so one of the reasons is my son is a degenerate gambler sometimes, where like we'll be out golfing and he's 9 and says, well, I'll bet you $20 you can't make that putt. I'm like, dude, that's my 20.
How much, how much is
Yeah,
the
well,
20 bucks
I
is
will
gonna
say he's a saver, and he saves and saves and saves, so he knows he has it, so he doesn't blink when he spends like way too much running on Robux or Fortnite V-Bucks and Fortnite, or trying to bet me $20 I can't hit a putt. And so we're doing the Smart Money, Smart Kids book. And we also signed up for, I won't say the name on this because I don't want to endorse it. I don't know if it's good yet, but we're going to try one of those kid debit card programs.
Okay.
So what we'll do is with chores, we will load the debit cards and then they can take, and he can go down and buy baseball cards or Pokemon cards or whatever it is, or Lily can do the same with whatever she wants to blow money on. But it allows us some visuals. I think it's a little bit for older kids because they're supposed to carry the app on their phone, and our kids don't have phones.
Right.
But we might try and put it on their iPads or
So
something like
to add to that, it is different times between like how we grew up, right, and
that.
how
Yep.
our kids are growing up. Because I would say we got allowances just by my parents handing me, five
Cash.
dollars in
Yep.
cash, right?
Mm-hmm.
Exactly. So my kids, same thing. I have a bank account for them, but I just transfer money from one bank into their bank account because the cash they don't carry it around, and it's so much more of a cashless world. Again, like you said,
Yes.
my kids would prefer to spend money on Robux. And to those that don't know what that is, it's a video game where you go and you have digital money that they're spending in a video game world. It's probably the best way to say
Ryan,
it,
just
right?
call it crypto.
The $5, yeah, the $5 bill that they have that you would give them an allowance is going to do no good in that. It's got, I
No.
mean, you're gonna have to put it on your credit card anyway. So much of this is digital, and so you do have to realize that the way that we grew up is a little bit different, and how we're going to handle things are going to be a little bit
I mean,
different.
when we were trying to start this, my wife said, well, can't we go down to the bank and open bank accounts for them? Because I don't know if you had this, but I had a little passbook savings account. I've got a calculator, but you get a little book and you deposit, your parents take you to the bank and you
You
deposit
write
money. And
down.
it is, I mean, the two branches of two different banks that are closest to us have both closed. The in-person banking is quickly going away. And frankly, I think the thing that got me onto this digital thing with the debit card that gets loaded up is that, yes, it'd be much easier to be able to run down to the branch and the kids would write down how much they deposited and add it up, and almost like balancing a checkbook. No one balances checkbooks anymore.
Right.
You do things like use Quicken to manage your personal finances. And if you think it's going to become less digital in the future as they turn from kids to tweens to teenagers to college kids, you're lying to yourself. And
Right.
and so trying to get them set up with some tools to be able to manage the digital side of managing money. I don't know, but we're embarking on this. And so
Well, you're on the right path because I mean, as we all know, finance is important. So you teach your kids early on, then
Yep.
they probably at least grow with some good habits going forward.
That's my hope. That's my hope. And we'll see. This isn't an endorsement in any of this stuff, but this is, if we're talking about what has our attention this week, this is one of the focuses that's going on around my dinner table at home, is trying to get these kids set up and on the right path for financial success,
Yeah.
because it starts early, just like learning how to hit topspin on a forehand, or learning how to stripe your drive down the middle of the fairway. The earlier, I learned golf in college, and so I'm always terrible, but I play with people who picked it up as kids, didn't play for 20 years, and they can still shoot something in the 80s. That speaks to learning skills when you're malleable, right? Like,
Yes, yes. It's
when you're not afraid of falling.
you can grain it early and it'll stick with you.
Yeah, and even if something gets a little bit wayward, they know how to self-correct, whether
Right.
it's a serve or skiing or golfing or managing their finances. So that's my hope. So stand by when we do this again. Hopefully I can report back and maybe even endorse one of these things. We'll see, but anyway, well, we've been going for a half hour. It's hard to believe, but this was a long one. I will post in the show notes, whether it's the Casual Friday webcast or in the show notes for the podcast, links to the visual capitalist charts that we put up, as well as like the one from Detrick and Bloomberg and a couple of the others that we kind of cobbled together. If you have questions about anything that we went over today, you can email us at info@forwardfg.com. I'd say subscribe to the podcast. We still, it's not every week, but most weeks we post on the podcast, and you could subscribe to us on Spotify, Apple podcasts, or kind of wherever you listen to podcasts. And then of course we'll post this on YouTube, and so you could subscribe to our YouTube channel to not miss any of these videos. So Ryan, with that, we'll do this again in another couple weeks.
Yep. Sounds good. Thanks.
All right. Have a good one.